Welcome to the Trust Us, We're Professionals podcast with your friends from SSC, CPAs, and advisors. This is a podcast where we use movies, TV, news, and sports stories to make complex financial matters more consumable for our listeners. We are all licensed financial professionals, which makes us truly, madly, deeply qualified to have a podcast and talk about these things. I'm your host, Chris Underwood, a financial advisor with SSC Wealth, and I am joined by the lovely Michelle Hammond and special guest Tim Metz, a senior consultant at SSC and a recovering banker.
A recovering banker. You want to tell them what that entails? You wake up in the middle of the night facing all your bills to one direction?
No, actually, I wake up in the middle of the night wondering who isn't going to pay their loan back.
Oh,
That was
so you're still recovering.
still, yeah. I'm doing talk therapy.
What?
He talks to me about it a lot. I guess that's therapy. I'm going to send him a bill.
Okay. In today's episode, we are going to talk about what is one of the hardest things a business owner or an entrepreneur that they have to deal with, and that is finding a good business banking relationship and getting financing. And we're going to do that by referencing the 1990 movie Pretty Woman.
See, I don't know why you have that questioning sound in your voice.
I'm not sure either.
I'm here to make the argument that there is no better representation of what it feels like to be a business walking into a bank asking for money than the scene in Pretty Woman where Julia Roberts walks in and she's wearing the infamous white dress, blue skirt, O-ring, holding it together. She walks into the store in Rodeo Drive looking for something.
You got nice stuff.
Thank you.
How much is this?
I don't think this would fit you.
Well, I didn't ask if it would fit. I asked how much it was.
How much is this, Marie?
It's very expensive.
It's very expensive.
Look, I got money to spend in here.
I don't think we have anything for you. You're obviously in the wrong place. Please leave.
Michelle, I might let you ask this next question.
Metz, you were a banker for a significantly long period of time. Did you ever have an escort come in and ask you for a loan?
Oh, probably. I mean, it's not like they're going to come in and say, hey, I'm an escort. Can I have a loan? Because the first thing I'd say, if you're an escort, why do you need a loan? You make more money than I do. Okay. But
Probably.
let's qualify this. I have had a stripper come in
Okay.
and ask for a loan. And, the funny thing about that whole deal is, of course, strippers wear that like a badge of honor. It's legal. They can do it. But, she came in and she wanted a loan and she needed to open an account. She opened her account with $5,001 bills.
Was the loan, did it have some kind of collateral that was actually repossessable?
That we can talk about on air?
Yes, it was a car, and it didn't involve a metal ring holding two garments together.
Okay, perfect.
Yeah.
I am sure if you did have somebody come in who didn't know what they were asking for and were out of place or out of sorts, that you would have treated your clients better than those ladies on Rodeo Drive there with Julia Roberts.
Oh, sure. Yeah, they would never make it in banking. They wouldn't last 5 minutes. But, maybe on Rodeo Drive, they might last a year.
But, you're a small business owner and you go into a bank and you're looking for financing and you are the metaphorical escort in a Gucci store, right?
Mm-hmm.
Uh-huh. And unfortunately, there's things that you might be doing in your business that put you in that situation that make it harder or you feel less prepared to be able to go in and start this financing relationship, right?
Yeah, I mean, we all have varying levels of sophistication that we look for. I mean, you for sure don't want to walk into your, banker's office for the first time and, take your chewing gum out of your mouth and stick it up underneath their desk. It's probably not going to go over very well, but I've seen it all.
Yeah. I mean, like, you have seen it all. So let's jump in there. So
Okay.
what are some things like We talked about this when we were getting ready for the podcast, and this kind of cracked me up because it happens, right? Like coming in without an appointment, just
Oh
saying, I'm
my
here to
gosh.
talk to somebody about a loan.
Yeah, somebody who wants a $500,000 loan for their small business, and they just want to drop by and talk to somebody that they don't know about it, completely unprepared, conceptually. And an hour and a half later, they're gone, and you never see them again. I mean, if we were going to do the old top 10 list of things that irritates bankers, that's probably number one. Somebody who just comes in and they have no concept, they're unannounced and unprepared, and they don't value your time enough to actually make an appointment. It's a relationship. You have to start off with some measure of respect for what's going on. The first thing you're taught in banking, and it's reinforced over and over again, is that you really, and contrary to the Julia Roberts deal, you don't really judge a book by its cover.
No.
But you can judge a person by their actions. And on my top 10 list of things that would annoy about any banker, they're all about actions. They're all about things that either show you're not in your business, you don't know your business, you don't understand the banking industry, or why perhaps you're even there in the first place. And so, yeah, I mean, banking is about understanding, who you're dealing with on the other side of the desk, and what their true motivations are. So, when I go down that list and I think about it, the not showing up, it seems kind of childish, but it's real. I wear it. It's a badge of courage that, I've had lots of people come in that way. So,
Okay, well, let's say they show up without an appointment, but they have their business plan, right? They have a nice written business plan that they are committed to, and that they can explain it so well. That helps a lot, right, Tim?
oh, it helps immensely. And, and I love those situations. I mean, I love to be proven wrong. I love somebody to come in my office without an appointment, drop down comprehensive financial statements, a well thought out business plan, and have a very detailed conversation about what their ask is, and that they just want to get to know me. I mean, yeah, I mean, having a well thought out business plan and understanding what's in that business plan is really a critical component to this whole thing. And so, yeah, I mean, when I say you don't judge a book by its cover, you don't, because I have had people come in, and when I kind of got over my initial frustration with them just walking in the door, and they brought all of their data, and it was so good, I thought, this is a really lucky day for me.
Yeah, absolutely. But some things that can make you go,
Yeah.
right?
Oh yeah. Yeah. The person who hasn't generated any financial statements in 2 years or 3 years, you ask them if nothing strikes fear in the heart of a banker more than when you ask somebody for tax returns and they say, "What? What do you mean, what?"
Like my receipt from Dylan's.
Yeah, it's
Or
that's
when they're old, right, Tim? Like I always feel like if they're giving
stale.
if
Yeah.
they're on extension and it's 10 months after year end and they still haven't finished their tax return.
Right.
Like,
And they don't have a good reason for it.
yeah.
Because there are reasons
There
to
are
extend, but by and large, yeah. I mean, when you come in with stale information, you want me to make a decision today on something that happened 10 months or 18 months ago, it isn't going to work. Every client, and I use this analogy a lot, every client, and to a lesser extent, every meeting is like peeling an onion. You sit down and you have this beautiful onion in front of you, and you start peeling it back, and you learn more and more and more. And so, the first question is, what are you here to see me about today? And you kind of get the gist of that. Well, what kind of data do you have? You get a business plan, you leaf through it, and that gives rise to other questions. So, you start diving into, well, tell me about your partners. Who are you in business with? Well, it's myself and 2 other guys, and both of them declared bankruptcy last year. Okay, well, that tells you a lot about, oh, maybe I don't want to go here.
Wouldn't it be nice if they actually said that in the statement? Because it's more like 2 other guys. And you're like, oh, great, sounds great. And then you're about ready to write the loan for them. You do the credit check, and they've had 2 bankruptcies.
And they've had 2 bankruptcies.
It'd be nice if they told you up front.
Absolutely. Or I love the ones that come in with a credit report, and you pull it and you look at it, and they have just late pay after late pay after late pay after late pay, delinquent mortgage, delinquent student loans. And you ask them about that and they say, really?
Oopsie poopsie.
Well, I really, and my favorite approach there was always to just turn around the credit report and put it right in front of them and say, yeah, right here and right here and right here, and just watch their face, and they always know.
Are they? Oh, I was about to say, are they naive or do they know? And
No, they know.
They're just trying to hit a Hail Mary.
Right.
Yeah. Okay.
Yeah.
What are some other kind of warning signs or layers to the onion?
Well, there's always the person who comes in and they've got this really great business idea, but they've got no money. So they have no ability to contribute any equity towards the project whatsoever. They want the bank to finance 100% of everything they're doing. And they have no concept how a bank works. You got to have money to make money. You got to have skin in the game. It's a sign of commitment. And, so, you see that a lot. And to me, that's just an indication of a lack of sophistication and a little bit of a lack of understanding how banks work. My favorite, though, is the person who comes in and they want to borrow money to pay back taxes.
Oh, gosh. Oh, gosh.
Does
that happen often?
Yeah.
Yes.
Happens all the time. That might be a very common reason for denial. Oh, yeah, well, I owe the federal government about $300,000 in past sales tax or whatever kind of tax it is, and can I borrow money to pay that back?
Is there ever a scenario as a banker where even though they needed it for that, it might be justifiable and you might have done it?
No.
Okay.
Never.
I retract the question.
Take that one back. Nobody has a
Yeah. Oh, Jesus. No.
Well, I don't know. Maybe they have a building that's worth $1 million that they're putting up as collateral or something.
Yeah,
I don't know.
but the federal government has the biggest stick of them all, and they're always going to be the priority creditor, even if it seems like they're insecure. The unsecured, the insecure works too.
Yeah.
The federal government is insecure, but it also happens to be unsecured, and no, you just don't do that because that speaks loads to a lot of other issues. Like I love the business that comes in and they haven't paid sales tax for 2 years. And in the state of Kansas, of course, they send you lots of letters, but what they love to do is they love to show up to your door and they do a thing called a till drop where they open all your cash registers and they take every penny out of your cash register that day. Or even better yet, they just come and they padlock your front door and put a big thing that says closed by order of the state because you owe us money. And this person comes to me in a panic and they say, hey, I need money because I haven't been paying my sales taxes for the last 2 years and the state's closed me down. And I say, but wait a minute, didn't you actually collect those sales taxes at the time of sale? Well, yes. Well, then where'd the money go? Almost always it's dead silence. Dead silence. This is why you don't lend to pay taxes, because somebody who owes lots of taxes has not been paying attention to the Apple Card.
Yeah, it's never, their personal affairs are never in order either.
Yeah.
Yeah, all sorts of boats and, high expense items, things like that.
Yeah.
Oh, Tim loves to get a personal financial statement that is very heavy on vacation houses, boats,
Jet skis.
guns, artwork.
Art. Oh.
And let's define artwork. Taxidermy.
It's in the eye of the beholder, Michelle. It's in the eye of the beholder.
Yeah.
But then they're $100,000 back on their sales taxes.
They have all this stuff, and I mean, it also flows through to the whole thing, the whole concept of people who basically have lots of toys, and they come to you and they bring you a personal financial statement, and they have this huge net worth. It's like $2 million, but they have like $2.3 million in debt, because their house is leveraged at 95%. Their cars are leveraged at 100% because they buy, and they buy it all on credit. They have no personal wherewithal when you get to the bottom of it. And in my opinion, the stronger you are personally speaks loads about how you are as a business person, that you know how to save money and you understand the value of money. And so that would be my last one on my list of things that I've seen, and that is just folks coming in and they're overextended, and I actually feel bad for them, because there's no way to get out of that. But there's no way I'm getting into it.
Which is ironic, Tim, because as we were thinking through Pretty Woman and the plight of the small business owner, I definitely see you much like um, the hotel manager that helps Julia get a dress in the famous scene, where she eats at the dinner table and shoots the escargot across the way. But the only reason she knows how to sit at the dinner table and get all this done is because she was graciously shepherded through and taught what to do by the hotel manager. So I've always, but I don't remember who played that.
Hector, I'm going to mispronounce his last name. Great actor, Hector Elizondo,
We're
something
just
like
going
that.
to say Hector.
Hector works.
Hector.
Everybody needs a Hector in their life to help them navigate through this so that they can go to a fancy cocktail party, right?
And shoot an escargot.
Yeah, and then everybody also needs a sugar daddy as it relates to Richard Gere, right? Let's talk about bankable.
But we should also give Julia Roberts credit because she had her affairs in order, no pun intended. But remember her roommate, Lauren Sangiacomo?
She was even worse off.
That's what I'm saying.
Yeah.
So she was Julia Roberts as far as in the movie, as far as escorts go, she had her stuff together. She wasn't a drug addict or anything like that. And you said the stronger the person is, the better. Yeah.
You keep kind of reaching to your chest
Because
area.
I'm trying to understand the analogy.
Stick with me. Julia
Okay.
was on her way to bankable. Okay.
Yeah, she
All right.
was.
She was on her way to bankable. All right. So she has Richard Gere, who marches her back down the next day to Rodeo Drive to say one of the things that I believe to be incredibly true.
Stores are never nice to people. They're nice to credit cards.
Stores are never nice to people. They are nice to credit cards. For those of you who didn't hear that, I think that's always could always kind of in the back. That when people have credit, when they have the ability, they get more loans. They do the things, Tim, right? So we got to do the things to make sure that stores and banks are good to us, right? So we don't all have a Richard Gere who's going to come lay down their black Amex to let the bank loan us as much money as we need to have loaned, right, Tim?
No. And I know I sure don't.
So what makes people bankable if we don't have a black Amex to lay down? What makes a bank want to partner with somebody to loan them money to help their business?
Man, that's a loaded question, but it's an excellent question. And it really comes down to the person. I mean, it does, I want to see somebody, who has a plan, who's taken the time to develop things. They've got ideas. Like you were starting to say earlier, I would pretty much help anybody if they had a well-developed plan. And I have in my career.
In the banking world. We should.
Yes.
Yeah.
Thanks.
T.Metz at SSCCPAS.
Forwarded to M. Hammond at.
It will help anybody. We are now making loans.
We are. Yes. Yes.
No, we are not.
No, but it's true. I mean, most bankers really are kind of service-minded. They want to make loans.
Right.
It's not that bankers don't want to make loans. They absolutely want to make them. But, they want to see that the other person involved in that relationship is capable of handling it. And so, I have stretched on many occasions to help people that I think even some banks wouldn't make those loans to because they exhibited characteristics that I consider to be super important in the relationship. We're always taught in bank school, and believe it or not, there is actually a bank school.
Sounds so lame.
Is it next door to clown school?
No.
There's a
Down
clown
the
school,
street
too.
from accounting school.
Yeah.
It's ugh.
Yeah, we actually, play volleyball against each other. It's, pretty interesting to watch, but,
Oh, yeah. I'll leave that one alone.
Is there beer there?
no.
Oh.
Yeah. No.
Seltzer water.
Oh.
Yeah.
This is
Hard seltzer?
No, that's
No.
at clown school where you
That's a
squirt
clown
with each
school.
other.
That's a crusty clown school.
Well
Okay,
done.
no, now seriously, Tim. Now.
Well, so they teach you this thing. It's called the 5 C's of credit. And it's a tongue in cheek thing, but it's basically, there's kind of 5 components to making a credit decision. And you want to make sure when you're deciding if you're going to give somebody a loan that you go and kind of work your way down that list. And, after you do it long enough, it just becomes second nature. It just becomes part of your interview process that you're asking questions about these things. And they have them ranked as to what they think are the most important. And
Well, let's tell our listeners, okay? Like if I'm being judged on the 5 C's.
no, I'm going to tell you.
You going to tell them,
yeah,
or are
I'm
you going to
gonna
hold this
preach.
banking school secret?
No, I'm gonna preach it. I'm gonna
Okay.
preach it here in a minute. But
Okay.
I have my own take on it, because over my years of banking, I've learned that certain of those 5 C's are actually far more important than what the experts say. Okay.
Well, you are the
And-
expert today, Tim. So tell us what
that's
you
scary.
think. Tell me about the 5 C's.
Well, in my opinion, the first one that gets top billing every time is character. Because I've learned time and time again that what matters the most is not what somebody does the day they come in to see you to get the loan and the day they sign on the dotted line. What matters the most is when something goes wrong, because that's the true test of somebody's character. And I have had clients suffer utterly devastating personal consequences that destroyed their finances, and figured I would be writing that loan off. And that person did everything in their power and scratched and pulled, and they paid the loan off. And, and if that person came back to me 5 years later and they needed a loan, I would make that loan to them without huge diligence, because character means you can have perfect financials, you can have money, you can have earnings history, you can have all these great things, and you can still be a crook.
Absolutely.
And you can still be somebody that doesn't do the right thing when it counts. And so, in my opinion, character is the absolute most important thing. So how do we evaluate character? Well, coming back to credit report, when I first started banking, I thought credit reports were kind of like dumb. It's like, how do they really assess this? But when you look at credit reports today, they're sucking in millions of transactions a minute, and they're sorting that data and they're parsing that data. And yeah, on occasion they make a mistake. But I've learned over the years that a credit report is a killer indication as to how somebody lives their life on a day-to-day basis and how they handle their finances in particular. And so, at first I didn't pay a lot of heed to it, but there's a close correlation. And somebody who presents to you and you pull their credit and it's awful, unless they have one excuse that I do allow that I've allowed in my world, it's best to avoid them. And so it's just a huge indicator of character. Now,
well, what's the excuse? I'm sure people would want to know. I mean,
yeah, no, it's true.
Make sure you're recording, BJ.
It's a medical event.
Yeah.
I mean, we're the only country, I think, in the world where a severe medical event will bankrupt you. And you know what? That's a variable you can't control.
Right.
And so that would be one of those really adverse situations that you'd see on a credit bureau. And I would take that into consideration. And I've made many loans to people who had a recent medical bankruptcy, because they just, that is no indication of their character.
In addition to the credit report, I mean, there's a reputation that precedes most people as it relates to how they have relationships with their vendors.
Yep.
How they have relationships with their employees.
Totally.
Are they constantly in litigation?
Yes.
We mentioned the partners earlier.
Yep.
If you're good and your partners are that all goes to the character of the transaction, of the people with the transaction that we're going to make.
Right.
So,
you only have one reputation.
No.
And it's yours to lose.
Right.
And so that is so true. Everything you said there is exactly right. And I would
Judge you by the people around you.
It sounds like my grandma.
That's why I said it.
I would even check the court records, because court records can say a lot about, how somebody treats people. But, when I went to law school, my contracts teacher was this very flamboyant man, very theatrical. And he used to always say, and he would hammer this home, contracts are a study of relationships. And he's dead right.
Oh, yeah.
And banking is a study of contracts and relationships. They're all the same thing. And so in my book, character is top.
Okay.
The other 4 factors of the 5 C's, in my opinion, they just kind of muddle around together. So, the second one, we look at capacity, and that goes hand in hand with what I was saying earlier about kind of one of my pet peeves about, what's your personal capacity to handle your debts? Are you spending $5,000 more a month than you make? You clearly don't have the capacity to take in any more debt, and or your business doesn't. And so that's going to be something that I'm going to look at. And so, when people ask me, how do I become more bankable? First thing I say is, if you have a lot of debt, pay it down. You got to have positive cash flow. At the end of the day, you got to have positive cash flow. Capital is the third of the 5, and capital is closely related to capacity. If you're completely leveraged, you have no money to put into your business. You have no equity in your business. And if you think about this from kind of the banker's perspective, which, I support bankers. Nobody ever thinks about it from our perspective, but
God,
where's call the ambulance.
Oh, yeah.
But when you think about it from
I like you did the woo
woo. When you think about it from a banker's perspective, when you come to me for a loan, you're basically asking me to take a risk on you.
Mm-hmm.
And if you have nothing at all at risk of your own into the game, you're basically asking me to just shoulder all of the risk. Not only is that unsophisticated, it just doesn't, it's not how it works. Mm-hmm. So, having some capital, having some net worth is super important. And of course, we're a bank. The 4th C would be collateral. You got to have something to pledge. Now, there's programs you can use that allow you to mitigate collateral shortfalls. And I've used those a lot over the years to help good businesses that might have been short on collateral. But, there's a lot of businesses that come into the mix that actually, like the classic accounting firm, doctors, lawyers, architects, all they have are desks and computers.
You want my 5-year-old laptop, Tim, if something happens?
No,
not at all.
No, because it would have all your Amazon shopping on it.
It's true. It's true. Just not a lot of hard collateral over there. I've got a lot of great clients, but I can't really put them up as collateral.
Right. No, you can't. And a bank doesn't want them.
What would you do with them? Start providing accounting services to them? Probably not.
Yeah.
What about collateral? What if there's a questionable candidate, but the collateral is really interesting?
I will pass every time.
A lot of banks will not.
Yeah, a lot of banks will not. Let me say I'm the exception to rule there, but you know what? It is not a productive use of my time to liquidate somebody's collateral. What I want to be spending my time doing is helping people grow their businesses. I don't want to be dealing with their nuclear waste. So if they've got questionable character and they've got killer assets, I don't want anything to do with them, because in my life, I've learned questionable character like that always comes back to bite. And I don't need to go there. There's plenty of great borrowers out there that I don't need to go with those kind of people. So, but collateral is important. You got to have something, if you're going to, and I was kind of going down the rabbit hole of the professional services businesses, and, we have to make loans to those folks based upon their cash flow. And sometimes we have to use these mitigants to get over this collateral hump, and understand that some of this is driven by the regulators. Every time a bank makes a loan, within 18 months, they have a regulator that comes in and examines that loan portfolio. And it's very easy for them to Monday morning quarterback and say, hey, why'd you make that loan 18 months ago? They're not sitting at the desk, but they asked that. I've been asked that many times. Why? Tell me why you made that loan. Well, because A, B, C, D, and E. Well, but what about this? And so, some of this is driven by the regulatory environment that banks live in. And so enough about that. The last one that we kind of look at, and actually this one might be kind of number 2 in my
Why'd
order.
You put it as 5 when we wrote this out then?
Well, because
it's just save the best for last. Save the second best for last.
It's just showing. I'm processing on the fly here.
Okay,
so,
go ahead.
Conditions. So that's where you're looking at economy and industry, and the reason why I say that's probably number two is, your average bank and your average banker is only as good as the most recent deal they got burned on. And when I think back through the deals that I've had that didn't work out, there are almost always two causes exclusively each time. The first cause is something I missed in management, some sort of assessment I missed in the management's capability, and they tanked it. Okay. I mean, I'll own that one fully. But the second one, which has a huge role, is the effect of the economy or their industry in particular. And I'll give you just one small case in point. And I can give these horror stories all day long, but I made a loan to a durable equipment medical supplier. Okay. So they're selling scooters and oxygen systems and all that sort of stuff. And they come in, great collateral, great income, excellent character, everything down the list. But they generate 90% of their revenues from Medicare. And they're going along. And as Medicare is prone to doing, they suddenly decide, well, we used to pay our bills in 30 days. We've gone to 60 days, but all of a sudden we've decided we're going to pay in 120 days. And this is a business that has to buy large amounts of expensive inventory. And so overnight, their cash flow just skidded to a halt for 4 months. Mm-hmm. And so you have to really pay attention to the economy, where you think it's going to go. You really have to pay attention to their industry. And that's why I think that's number two, because that's a variable that nobody can control.
Right. What I think you're doing here that's so incredibly valuable, Tim, is telling our listeners, the criteria upon which they're being evaluated for the start of this financing relationship, right?
That's right.
There's so that what you said there was some soft stuff, right?
Yeah.
There's some hard stuff too, like some numbers and some calculations. And these ratios are calculated on their financial statements. Right. They're calculated on the projections even to see where they'll end up after the loan is made and the new business is purchased or the new line of service is added, right?
Right.
And you guys calculate these ratios, and then you look to see if they fall in a tolerance of what the bank's willing to accept.
Yep.
And then you also compare them to their peers, right? Which
that's
I always think is super interesting.
Yeah, that's exactly right.
So I don't want to get too geeky and have PJ break out the whiteboard again for us to calculate things. But a couple of these ratios that we look at.
Sure.
The quick ratio, do you want to talk about what that is in the banking world?
Without getting geeky, it's just how much stuff do you have and how much debt do you have against it? Okay. So, what's your current assets divided by your current liabilities?
So my cash, my AR, my inventory,
right,
divided by my accounts payable and my other liabilities.
Accruals, right? Right. Whatever you've got sitting out there.
And you want me to probably have 2 times more assets than I have in liabilities?
Yeah, I mean that's a solid number, but 1.5 is good.
Yeah.
I don't know that there's a total, kind of benchmark quick ratio or anything like that. Certainly industries have benchmarks, and that industry data is really solid. We can get that from a lot of sources. And so what we're essentially doing is we're taking your financial statements and we're cooking it down into a series of ratios. And there's probably about 60 ratios that you could calculate.
60?
Oh, there's
we
a
only
ton
had
of them.
5 C's. You got 60 ratios?
Oh my gosh, we have ratios upon ratios. So,
So we got the quick ratio, debt to equity.
Current ratio, quick ratio. Those are the two liquidity ratios that show that your business has enough cash to meet its current obligations.
Okay.
And by how many times does it have that much cash, right? So that's a real critical measure of liquidity, and it tells us that your working capital within the business is probably sufficient to carry you forward. Another one that I always like to see is debt to equity. It comes back to everything we've said multiple times today. How much debt do you have to what you have in the business? And if you have a really high debt to equity ratio, I'm not going to like that.
That means a high debt to equity ratio means that I borrowed a bunch of money and took a lot of the bank's risk onto my balance sheet. Right. And I took all the rest of the money for myself. Right. Because equity decreases when you either lose money or take it as a distribution.
Take it as right.
So having a high debt to equity ratio is that kind of skin in the game thing that we talked
Yeah,
about. Like
exactly.
that you bank or business is leverage, right? Like you go to a bank, you get the leverage in order to be able to grow your business at a faster rate than just retaining all of your cash,
Right.
right? But only to a certain extent that you're also retaining some of your cash
Exactly. I mean,
and getting debt.
we want to see that you're doing that. It comes back to capital structure. It comes back to all of these things about how your company is set up. And so, yeah, debt to equity is really important. I think it says a lot about a business. And um, the other one that I think, depending on the kind of business, we'll look at inventory ratios, so, how you're handling your inventory, those sorts of things. But, when you kind of get down to the whole, what I call the debt coverage ratio, and so banks love quick and current ratios, but they really love the debt coverage ratio, because what that says is for every dollar of profit I make, I am paying X dollars of debt against that. Okay. So kind of the minimum, I mean, a 1-to-1 is below the minimum, but a 1-to-1 says if I make $1, I'm spending $1. Okay. So that's,
Which is kind of like how I perceive what I spend.
yeah, you just kind of spin in your wheels.
Like,
right?
I got the paycheck. I might as well go buy.
Yeah.
Trip time, right?
Yeah.
Dollar in, dollar out.
Dollar in, dollar out.
Okay.
And so the kind of the minimum that most banks use is a 1.25 to 1 ratio. So they want to see you make $1.25 to every buck of liability you've got sitting there. And the stronger that is, the better. And why this is so important, especially now and for the last 15 years, is debt's really cheap. And so, 40, 50, 60 years ago, people didn't start business with lots of debt. They started it with money and hard work. Oh, I sound like a banker.
You sound old.
Yeah.
I do. I sound
40,
old.
50 years ago.
Actually, my knees hurt.
Holy
Boy.
shit, I wasn't even born yet.
Thanks.
You're welcome.
My day.
Thanks.
Back in my day, it took on nickel.
Yeah, well, So anyway, back in my day,
interest rates were 18%.
they were 18%.
Point, right?
Yeah, my first home loan was 12%. And today people would absolutely commit suicide if they had to pay a 12% interest rate. I mean, it's the way it works. And so, this is really relevant today because folks are really, they're over consuming debt. Yeah. They're taking lots of debt on because it's cheap and it's a lot easier
everywhere
to finance growth. And the Fed still has the safeties off and money's going everywhere.
So it's everywhere, right?
Yeah.
So we're talking about a relationship with a bank and a lender that you build over time.
Mm-hmm.
Now there's stuff you can hop online and get some business loans from this bank in the sky, right?
Yeah.
Right? You can get loans based upon your cash flow. You can factor your receivables. You can do this kind of transactional lending where it serves a purpose.
Mm-hmm.
When you look really good to that place, you got to meet there. Yeah, but if things go bad,
it's bad.
It's bad because they're a bank in the sky. So maybe talk a little bit about transactional lending.
Oh, yeah.
Versus a relationship that we're talking about building.
One's
here.
an escort, one's a sugar daddy, right?
No, a sugar daddy gets it. What are you doing? Get your terminology correct.
And get out of the gutter.
I want a sugar daddy, but I'm not an escort.
Right. And I am an escort.
I thought you were going to say I am a sugar daddy, and we were going to really break that down a little bit more there, Richard.
Yeah.
So, right, like what we're talking about is not helping you go get the loan from the internet-based lender, right?
Right.
We're trying to build a relationship so that when things go a little bit south, right?
Yes.
That you have a relationship with a banker that knows your 5 C's. You're talking to them about your conditions in your bank, right?
Mm-hmm. And they're invested in you.
And they're invested in you because they know your character. And so maybe they're going to allow you a 3-month moratorium on principal payments. Right?
Yeah. I'll say a little bit about, kind of the transactional side of things. Because, I've had people come in and they want a transactional loan. All they care about is rate and term. They're never going to do any other business with me. I've done those. I don't like doing those because I think that they're not very interesting for one thing. But, when you get into the transactional world and you start dealing with, like you said, bank of the sky or, cloud-based banks or what we refer to as non-bank lenders. Okay. Non-bank lenders, they serve an absolute purpose, but that is the Wild West because they're non-bank lenders. They aren't regulated like banks. They don't play by the rules that banks play by. And a lot of times their rules are really onerous and they're in super small fine print because they're not regulated. And I can't tell you how many times I've had people come into my office over the years needing to be bailed out of a really bad relationship with a non-bank lender who, like the factoring thing where they take a percentage out before you ever. So if you have an account receivable, you've sold something and you have an invoice sitting out there and you give this to this non-bank lender to factor. Well, the first thing they do is take their cut off the top. And so you get a diminishing return with everything that comes back into your account. And if that receivable goes longer, they take out even more. And so you just kind of lose ground. And I've had so many people come in over the years in those deals, and they're bad. So, that's the transactional world. I try to not play in the world. You'll hear lots of bankers say they're relationship bankers. I would say maybe 50% are truly relationship bankers because so many banks value raw production over relationship. And so they're just moving on to their next deal. But I think you want, as a small business, you want a relationship, and you want a relationship with your banker because, and what I mean by that, it's not that you just have a loan with them. You have your checking accounts with them. You might be using their wealth management group to manage your investments. You might be using your credit card, your merchant services through them. But what you have is you have a series of lines of business. So the bank is deeply involved with your business. They know every aspect of your business. That's a relationship. That's what a relationship banking deal looks like. And at the end of the day, that's what you want. It has a lot of benefits. We can kind of talk about that later. But I consider many of my relationships with former clients that became, like true banking relationships. They've also become friends.
You don't have to be friends with your banker for
No,
a relationship. I mean,
you don't. No, no,
I'm picturing some of the other bankers around here, Tim. You don't need to. They're really good bankers. They're great people, but I ain't getting drinks with them.
Yeah, no. Well,
evidently they don't drink. They just have the seltzer water.
Yeah.
At banker school.
Yeah.
At bank school, right?
Absolutely. Okay, so how do I build this kind of relationship? What helps this along through the process so that we can have that kind of relationship banking versus the transactional?
Well, the first thing is a lot of communication. I think having really open and honest communication with your banker, and where you're not only talking about what's going right with your business, but you're talking about what isn't going so well with your business because, at some point in time, you work enough with your banker and they get to understand you and they understand your business and they become almost a right arm. And you say something and they may have a suggestion to help you fix it.
Yeah.
And so that open and honest communication goes a long way to really cementing a good relationship. But I think that what follows on that is some of the more, kind of rote stuff. And that is, producing really good financials and giving it to the banker, frequently.
Right. Not just when they ask for it.
Right. You don't want your banker chasing you for your financials. You should be open and transparent. And boy, that goes a long ways to really forming a serious kind of trust relationship there.
Okay, guys, so here's some key takeaway advice for small business owners on building this banking relationship. Have a clear, coherent business plan. Know your plan. Stress test it. Be able to explain it. Know your credit score. Be able to explain your credit score and your business's credit score if you have one. Know your industry. Know the risks, what's associated with your industry, and how you're addressing those risks. Know these ratios that the bankers are looking at for your loans as it relates to your ability to pay it back, your debt to equity, and the other important ratios. Show the bank your experience and how you've been able to make things work in the past. And then invite the banker to your business. Have them come see
Super
what
critical.
you do, right?
Right.
watching the widget be made.
Let them kick the tires.
Kick the tires, do
Yep.
the thing, invite them, be proud, show off what you do. And if the bank doesn't want to come see what you do, then maybe,
Warning
just
sign.
maybe you don't, you just keep interviewing. And then as a little tip that just drives bankers crazy,
yeah.
you want to hit it, just don't put in your loan request your salary, that you need a $900,000 loan because $150,000 is to pay you. Just don't. Tim,
That's a nope. Yeah.
That's a nope. Bankers don't like that.
Right.
It might intuitively make sense for you that you need some liquidity to be able to pay yourself. Let's not write her on the piece of paper.
Yeah,
Okay,
it comes
guys?
back to skin in the game.
Skin in the game, because what we all want you to be able to do is to victoriously walk back into that Rodeo Drive locale and
Show them up.
Hi. Hello. Do you remember me?
No, I'm sorry.
I was in here yesterday. You wouldn't wait on me?
Oh,
You work on commission, right?
yes.
Big mistake. Big. Huge.
That is a classic scene. I remember seeing that scene, and that scene was from Pretty Woman, directed by Gary Marshall and written by J.F. Lawden and distributed by Buena Vista Pictures and Warner Brothers Pictures. I really like what you guys did today. You made that work. I was skeptical when I saw the outline, but you really did take it from bangable to bankable.
that's the goal.
Mm-hmm.
All right. On that note, thank you, Michelle. Thank you, Tim. That's it for today's episode of the Trust Us, We're Professionals podcast, brought to you by all of us at SSC CPAs and Advisors. If you ever have any financial questions, you can always reach out through our website, www.ssccpas.com, or email us. We'd love to hear from you at podcast@ssccpas.com. Timmy, do you have a Recovering Bankers Anonymous meeting coming up?
That's tomorrow night.
Makes sense. George, I'm surprised it's not on the weekend.
No, we're busy golfing on the weekend.
Oh, during the week. Okay, thanks.
See you next time. This podcast was recorded and is being made available by SSC Solutions, Inc., together with its affiliates and its employees, SSC, solely for informational purposes. SSC is not providing or undertaking to provide any financial, economic, legal, accounting, tax, or any other advice in or by virtue of this podcast. The information, statements, comments, views, and opinions provided in this podcast are general in nature, and such information, statements, comments, views, and opinions in the receipt of this podcast by any listener are not intended to be and should not be construed as the provision of investment advice by SSC to that listener or generally, and do not result in any listener being considered a client or customer of SSC. The information, statements, comments, views, and opinions expressed in this podcast do not constitute and should not be construed as an offer to buy or sell any securities or to make any investment course of action. The information, statements, comments, views, and opinions expressed or provided in this podcast, including by speakers who are not officers, employees, or agents of SSC, are not necessarily those of SSC and may not be current. SSC does not make any representation or warranty as to the accuracy or completeness of any of the information, statements, comments, views, or opinions contained in this podcast, and any liability thereof, including in respect of direct, indirect, or consequential loss or damage of any kind whatsoever, is expressly disclaimed. SSC does not undertake any obligation whatsoever to provide any form of update, amendment, change, or correction to any of this information, statements, comments, views, or opinions set forth in this podcast. No part of this podcast may, without SSC Solutions Inc.'s prior written consent, be reproduced, redistributed, published, copied, or duplicated in any form by any means.